You're staring at another investing app at midnight. It promises a stock that's about to triple. You've heard that before, from the AI startup. The pattern just keeps repeating. Here's the thing. You actually have money to invest. You save sometimes. You watch videos. You bookmark things. But somewhere along the way, investing got confused with gambling. The boring stuff, the stuff that actually works, disappeared behind everything loud and fast. Meanwhile, someone you went to high school with crossed 7 figures last spring. Not from a tip, not from getting in early on anything, from buying the most boring assets automatically every single month for 15 years. And they never posted about it once. Real wealth is built through assets too boring to make headlines. Everything exciting, everything that rewards your attention, it's a trap designed to extract money from people who haven't figured this out yet. Real wealth is built through assets too boring to make headlines. Here are the 9 boring assets quietly making ordinary people rich. Yes. This is the most boring possible answer. That's exactly the point. A total market index fund holds hundreds of companies in one basket. You don't pick winners. You don't predict trends. You just own the entire market. The S&P 500 has averaged roughly 10.3% annually since 1957. After inflation, the real return sits around 7%. Money left alone multiplies. $500 a month in a low-cost index fund at 8% for 30 years grows to roughly $745,000. You contributed $180,000. The market generated the other $565,000. You just kept showing up. The trap, believing you can do better. Over 15 to 20-year periods, more than 80% of professional fund managers, people who do this full-time, fail to beat the index after fees. The boring index beats the experts, because it doesn't try. The 401k is quietly powerful for one reason most people overlook: free money attached. 88% of 401k participants are eligible for employer matching. Most people either don't know it exists or leave it on the table. If you earn $70,000 and your employer matches 50 cents on the dollar up to 6%, that's $2,100 a year in free contributions. Every single year you participate, you don't do anything brilliant, you just claim what's already yours. Someone contributing 6% at $65,000 a year, capturing a 3% employer match. At 7% over 35 years, that account reaches roughly $870,000. 1 in 5 eligible workers don't contribute enough to capture their full match. They walk past free money every 2 weeks because the paperwork felt like too much hassle. The Roth IRA is the account that quietly creates more tax-free wealth than any other tool available to ordinary people. Almost nobody under 35 uses it properly. You fund it with money you've already paid taxes on. Then every dollar of growth comes out completely tax-free after 59.5. $7,500 a year for 30 years starting at 25. At 8% average return, it grows to around $915,000. You contributed $225,000. The common misconception, that your money is locked away until retirement. Wrong. Your direct contributions can come out at any time, no penalty. The HSA is the most underappreciated investing account in the entire U.S. tax code. Most people who have access to one are using it as a medical checking account. That's the wrong move. Triple tax advantage, nothing else in the tax code does all three. Contributions are tax deductible. The move wealthy people make: pay medical expenses out of pocket, keep the receipts, invest the HSA in index funds. $4,400 a year invested inside an HSA at 7% for 30 years reaches approximately $416,000. One treats it as a tool, the other treats it as a checking account. U.S. Treasury securities are loans you make to the federal government for a fixed interest rate. Backed by the full taxing power of the United States, about as close to risk-free as financial assets get. Series I savings bonds are built to keep pace with inflation. The current fixed rate is 0.9%. That fixed rate is at a 15-year high right now. You can only buy $10,000 in I bonds per person per year. These won't make you rich on their own, but they protect cash from inflation. Notice what these first 5 assets have in common. None of them require you to be smart. They're pre-built systems that already work. The truth is the opposite. The more you try to outsmart the system, the worse you do. Not house flipping. Not vacation rentals. This is buying a reasonable home you can afford, paying it down over 15 or 30 years, and letting equity accumulate quietly while you live there. But the leverage changes everything. 20% down on a $400,000 home that appreciates 3% means a $12,000 equity gain on an $80,000 investment. The trap: buying more house than you can afford. Housing now consumes nearly 48% of the median household income. Cross that line and the appreciation gets eaten by carrying costs. Dividend-focused index funds hold established profitable companies with a long history of paying shareholders every quarter. You buy the fund. The companies pay dividends. Those dividends automatically buy more shares. Those new shares pay more dividends. Dividends and dividend reinvestment have historically accounted for roughly 40% of the total return of the S&P 500 over the past century. The trap: chasing high yield. Sustainable funds yielding 2–4% from established companies are the ones that actually compound. The boring version is different, and it's what actually builds wealth. 1 or 2 single-family homes in stable neighborhoods. There's an entire industry selling aggressive real estate strategies that look great in a slideshow and end badly when something breaks. 25% down. Fixed-rate mortgage. Long-term tenants. You expect 3 things to happen slowly: the tenant pays your mortgage down. A property bought for $250,000 with $63,000 down might be worth $450,000 20 years later. Equity grows from $63,000 to nearly $400,000. The trap: leverage and overextension. Buying 4 properties in 18 months, then a recession hits and the whole stack collapses. This is the asset nobody talks about as an asset. And it's often the highest return investment available to anyone under 50. $2,000 spent earning a certification that raises your salary by $8,000 a year is a 400% return in year 1. The wrong version: spending $40,000 on a degree that doesn't measurably improve your earning capacity. That's not investing. 5 extra hours a week generating $1,000 a month side income, fully invested at 8%, compounds to nearly $180,000 in 10 years. Crypto, day trading, options, NFTs, penny stocks, MLM, Forex signal services, real estate seminars, whatever new app appeared on your phone tonight. It's that the data across millions of people over decades shows the overwhelming majority lose. 75 to 95% of retail day traders lose money. Wealth building is largely a function of how willing you are to be bored. The exciting financial life and the wealthy financial life are almost always opposites. Ramsey Solutions surveyed over 10,000 millionaires. 79% received 0 inheritance. 80% used their company 401k. The average age they hit millionaire status: 49. The average time from the start of their working life: 28 years. Slow, boring, repeatable. The boring assets are still here. Boring builds wealth. Exciting builds stories. The choice is which one matters more to you at 70.